Hi, my name is Felix Fry.
And I'm Marco Rajnica.
We're here to find great trading opportunities that target 150 to 400% returns. And you? Well, you're going to help us do it every single day. So welcome. This is the Winning Picks Podcast. This podcast is for educational purposes only. OptionsGeek LLC is not a broker-dealer. OptionsGeek LLC, Felix Fry, and Marco Rajnica are not registered investment advisors. Keep in mind, options involve substantial risk and are not suitable for everyone. Please consult your own investment advisor before doing any trading. Make sure you read the full disclaimer at the end of this episode. Marco, how are you, man?
Hey, I'm good. How are you?
Good. What do we got here today? The market's looking a little weak, but what do you got?
It's looking really weak. I don't even know what to look at, but hopefully we're gonna make some sense of it today. And before doing any of that, I was looking at QuantumScape today, QS again, and I'm curious to see your thoughts because you showed us that January 2019 structure. Yep. Now the stock seems to be, has reached its peak and now it's going down. So if you could do a little bit more of an analysis and show us, what's happening there, that'd be really cool.
Okay, let me pull it up. Let's see here. Pull up this. Okay, so QuantumScape. Okay, so QuantumScape, we had the structure the other day was essentially the January 29th. January 29th, the 100 strike puts versus the 85 puts. So they had 13,000 of those put spreads were bought, and then they sold 13,000 of the 100 115 call spreads. So we see the open interest there. So what are the clues there? So once we figured out what they were doing, what were the clues? The clues were, one, for sure, that they were buying the put spread, selling the call spread. We were seeing that they were paying $4. It was important. They were paying $4. So on the downside, they can make 11, a 15-point spread. They can make 11. So that's about 2 3/4 leverage. They can make 275%. Clue number one. Clue number two was that it was an odd trade because they were also selling this call spread, and there was a 15-point call spread that if the stock went up, they were gonna lose. They would have to pay 15 above 115. So they would pay 4 to get in, and then above 115 they had to pay 15. So they're going to win 11, lose 19, through the on the outside. So below 85, they win 11, above 115, they lose 19. Doesn't sound great. Sound great. So that's clue number two, that it doesn't sound great. Clue number three is that January 29th is an odd date, right? Usually people say, why not January 15th or February 19th or May, the regular expiration. When you start doing a specific week, January 29th, a red flag pops up or something. Like the question is why January 29th? Okay, so that was odd, right? That was another clue. The next clue was just the stock had just finished making this huge ramp. Okay, it was this, we're calling this the mountain, right? It's on this side of the mountain. It makes this huge ramp, and we've seen some weakness the next day, and at around 115, it was holding. Okay, so giving all that, I'm looking at the stock. I'm looking at what's trading. I also, one thing that I didn't mention that I was seeing, we were talking about people trying to short the stock, and I do see, but a lot of times I see things that I'm not really mentioning it. So if we're looking at this relationship, I'm going to explain to you something now that is very important. It takes a little bit of understanding. I got to build up to it. I can't just say it and then you're going to take it. You're not going to remember it. You're not going to understand it. You're not going to, at least if I explain it to you by putting the elements together and explaining, hopefully in a way that makes some sense, that you can maybe recall 20 to 30% of it, and then you can go back into the education and sort of and do the exercise again to make sure you understand it. But what I got to teach you first is something that's that most people don't understand or don't know. Many people don't know is basically what the Black-Scholes formula is. And to do that, I'm not going to start on QuantumScape. I pulled up here Coca-Cola to show you Coca-Cola. So we're gonna what I want to show you is this relationship between puts and calls. It's very, very important. It is the most important relationship in options that you're looking at. Okay. And when someone truly understands options, they understand this relationship. So I don't care that you know about calls. I don't care that you know about puts. I don't care that you do put spreads. I don't care that you make a lot of money trading options. If I'm asking you if you understand options, then you're going to understand the relationship that I'm going to show you. And that relationship is basically the relationship that the Black-Scholes formula, that Black-Scholes came up with. It is what made the Black-Scholes formula famous. It is what it is what the Black-Scholes does. And that's the relationship between puts and calls on the board. So I'm just going to do an exercise with you, and you're gonna answer my questions. Okay. So the first thing is that, in 3 steps of profit, I pulled it up here to make sure that you see it. So we're gonna, where is it here? It's called the options puzzle. Okay. So we can go back to, can find it at 3 steps. It's basically right down. Here's the education. Okay. For everyone, it's right here. That video right there, that video. Okay. Super important. I think one of the most important videos that I've made. Okay. 22 minutes. I walk you through, you could see some of the, some of the charts and whatnot. It's a video, but I also put the transcript down there for you to walk through it with charts and whatnot. It's basically giving you simple charts, and I'm going to show you, explain them and how to do it. But I'll do that right now with an example. Okay. With options, you can if you have 3 elements to the puzzle here, the options puzzle, you have stock, you have calls, and you have puts. Okay. Stock, calls, and puts. Any 2 can combine to make the third. Any 2 of those 3 pieces can combine to make the third. So you can take stock and puts and create a call. You could take calls and stock and create a put. You could take put and calls and create a stock. Okay. So there's 3 elements. You can move it around. It's like a little puzzle. Okay. That means they're all related to some extent. Okay. To create stock, okay, we said you could take the puts and the calls. How do you do that? You would essentially, if we buy the calls and sell the puts, buy the calls, which is bullish, and sell the puts, which is essentially bullish because you don't think it's going down, buy the calls, sell the puts, we're essentially doing the same thing as buying stock. Okay. It's the same thing. Okay. So I just want to prove that to you. I want to help you understand what I mean by that. It's the same thing. If you buy the call, let's just take it. We're looking at Coca-Cola. You buy the, let's say the 54 calls, okay, are 102, 119. Let's just say you pay 119. You buy the calls 119, right? Okay. You sell the puts at, let's call it, and if you do this mid-market, it's going to be, let's call it better. It's probably better to do it mid-market. You're going to buy this at 110. Okay. Mid-market's right around 110, right? Yep. Pay 110, and you're going to sell this at 90 cents, mid-market, 90 cents. Okay. And the market makers have the bid offer around that $1. Okay. And 110 and 90 cents. Okay. So if you pay 110 and you sell this at 90 cents, how much are you paying out of pocket?
20 cents. Right?
20 cents. Okay. So keep that in mind, 20 cents. Now, if you're buying the 54 calls, that gives you the right to buy the stock at $54. And if you sold the 54 puts, that someone has the right to exercise you, so that you would have to buy the stock at $54. Is that fair? Okay. So they would sell it to you and you would buy it at $54. How much did you take in?
20 cents.
Right. Well, we paid 20 cents, right? Sorry. We paid 20 cents. Right. So if we pay 20 cents and we are buying the stock at 54 on January 15th, right? We get to buy the stock at 54, correct?
Yes.
If we're buying the stock at 54, wouldn't you rather do that than buy the stock right now at 54.20? Right. I told you that it's the same thing. You buy the calls, sell the puts. Well, if I buy the calls, sell the puts, I'm basically allowed to buy the stock at $54. However, in order to do that, how much did I pay?
20 cents, right?
20 cents. So 54 plus 20 cents is the same thing. If I want to buy the stock, it pays 54.20 cents. If I want to do it via options, then I'm going to buy the call, sell the put. I pay 20 cents, but 20 cents plus where I'm buying the stock, 54 in the future, 54.20. Okay. Same thing. Make sense?
Yes. Yes.
You could do it the opposite way. You can actually buy puts and sell calls. Buying puts, betting lower. Selling calls, also not thinking that it's going to go higher, is lower. Is the same thing as shorting stock or selling stock. Okay, it's the same thing. We can prove it. Same thing. It's 90 cents, $1.10. You can pay a dollar 90 cents, right? Pay 90 cents, and you can sell this at 110. How much do you take in? 20 cents. Well, that means you're going to be selling stock in the future at 54, but you took in the 20 cents, so you're basically effectively selling at 54.20.
Right.
Okay. So either way you want to do it, it's the same thing. Now, it's not just the Black-Scholes formula is interesting because it's not just doing that. It works easily doing it in this option because there's only three and a half weeks to go. Okay. But there's also, if you could do this on, you could do this on any one, and I'll show it to you in a second, but it's also embedded in that there's some interest and there's also dividends. The dividend is not till March, as you see here. So, there's no dividend in play, dividend zero. And in fact, interest rates are so low that it's going to be very small amount, penny, 2 pennies or something like that. So effectively, it works easily by just doing the calls and the puts right now. There is a little element of interest and dividends, just so you know. Okay. But if we look at the 52, let's just take an example, just to keep going with this example. The 52 calls and puts, you could say this is about 250. Right, 250 mid-market here. So you buy the calls for 250, you sell the puts at 30 cents, right? 250 and 30 cents is how much?
220.
220. 220 and 52, 54.20. Okay, magic.
Right.
Okay, magic. That is the relationship between puts and calls. They have to match. They have to be together. Okay, as calls go up, the puts are going down, but still there's this relationship and it holds, and it has to hold because otherwise there would be arbitrage, there would be free money. The options puzzle goes through that dynamic and then gives you examples on if it doesn't hold, how you actually can make free money. Okay. Free money always sounds good. Free money always sounds good. It's conceptual. It should never happen. Okay, this arbitrage, if you will, should never happen. The arbitrage is held by the Black-Scholes formula, and that's what the computers make sure that there is no arbitrage, that nobody's just coming in there getting free money. If there is free money, then it immediately closes, and the arbitrage goes away because there was free money for a split second, and then it closed because somebody took advantage of it. But usually, there's no free money. It's a waste of time trying to find free money. Okay, so that's the Black-Scholes formula that holds. Now, that's Coca-Cola. You could do that, practice on any stock you want. Magic, you will see that sometimes it's a little bit off, and maybe you have to see then if there's a dividend, or if you go to longer dated options, then there's an effect of interest. So there's going to be a little bit of difference, but essentially that relationship is, you're going to see it happening. Now, let's go to QuantumScape. Okay, we're going to do the same, a lot wider bid offers. We're going to do the same calculation. Okay, the 100 calls, okay, wide. Let's just call this $9. Okay, $9. And let's call this one $32. Okay, $9 is somewhere in the mid-market, $32. Now, if I wanted to short the stock, okay, I have to buy the put, sell the call. If I wanted to do it through options, so I would pay, let's say 32, pay 32. You can write this down if you want, and I would sell the calls at 9.
Right.
32 minus 9 is $23. So net, it would be $23 out of my pocket. Do you agree?
Yes. Yes.
Okay, $23 out of my pocket. The stock is 100. So I'm effectively selling the stock at $100 on January 29th. Okay, I'm selling it at $100 at a day. That's where I'm going to sell it. If the stock is 200, my calls are going to be exercised. If the stock is 0, my puts are going to be worth 100. Okay, so at some point, I'm going to be short the stock at 100 effectively. Okay, sorry, at 100. Effectively, I did pay $23 to put this position on. Okay, so what does that mean? So yeah, I get the short at 100, but I actually paid $23. So net, I'm really getting short at $77.
Right, that's far off.
way off than 99.50. Way off. Okay, so everything I just told you about Coca-Cola, wait a second, it doesn't work at Quantum. right? It doesn't work at quantum. So the question is why? The question is, wait, what's going on? You just told me this whole story about the Black-Scholes formula. Everything is tied together. There's this relationship. Yet we look at quantum and it doesn't work. Okay, great question. So remember, I told you that the Black-Scholes formula is taking into account dividends. In this case, quantum has no dividends. And we did the exercise with the puts and calls correctly. We know there's no dividends, so that's out of the question. So then it has to be in this interest. Okay, now that leads me to the next element, if you will, of this whole thought process. The element is how to short a stock. Okay, when you short a stock, essentially, we talked about this in the overstock video, which I encourage people to go watch. But when you short a stock, or anybody shorts a stock, basically they're betting that the stock is going down. So if there's, quantum shot up from $10 to $125, the shorts are saying this is a battery stock. I was reading about the technology, and it's in, the testing they have done is in one state. When you're talking about building mass amounts of batteries in a factory, it may not be appropriate to say that this battery is going to work in a manufacturing setting when, who knows how they're building these things. That's what I was reading. To be honest, Frank, I don't understand the technology. I'm just reading sort of the process. But the point that I'm saying to you is that when you're looking at this and you don't see something, you see that it's not working, there's something wrong with either the dividend or the interest rates. In this case, the interest rates, and in that case, it leads me to believe there's something going on with the borrow. Okay. Mm-hmm. When you borrow stock, you have to actually pay something for that borrow. Usually, if you want to borrow Coca-Cola, it's going to cost you a penny. You want to borrow Apple, cost you a penny. You want to borrow any fixed stock with millions and millions of shares outstanding, it's going to cost very little. Okay, the borrow is very close to the LIBOR rate. It doesn't cost that much. However, when everyone wants to short QuantumScape, it's a supply demand. When everybody wants to short QuantumScape, when everybody thinks this is a crazy stock, I want to short it. How do I short it? I'm going to call JP Morgan. I can't short it until I actually get the borrow. Okay, I have to actually get the borrow from JP Morgan, or if you're at TD Ameritrade or E-Trade or Schwab and you want to short quantum, you have to ask Schwab, TD Ameritrade, or E-Trade, can I get the borrow for 100 shares or 10 shares or whatever you want to sell? They have to say to you, yes, approve, you got the borrow. Well, nobody has the borrow. Okay, right. What does that mean? That means the people, how do you get the borrow? That means for BlackRock, for Coca-Cola, for all these thick stocks, someone like BlackRock Vanguard, they have 5 million shares. They're lending it. The big boys, they're lending that stock because they're taking in a little bit of pennies here and there just to borrow the stock. They're long the stock. They don't care. Here's a nice way for everybody. If you want to short the stock, great. You want to play around, great. We're going to take in a little bit of money because JP Morgan, Morgan Stanley, Goldman Sachs, all these stock loan places, they're going to pay me to borrow my stock. Okay. In this case, there is no borrow. The banks can't find borrows. And so Black-Scholes, this relationship between puts and calls breaks down. Okay. It breaks down. So, and go ahead, keep going.
So why is that they can't have it? They can't find it.
They can't find it because the owners of the stock either are not lending it. They've decided we're not lending it to you. Right? Whoever owns the stock saying, I'm not lending it to you. And that's one reason. Or the amount of shares that are outstanding are already taken. People already are short the stock. Okay. So for example, if I'm a hedge fund and quantum was trading 26, 30, 35, I might say to JP Morgan, you know what? How much borrow do you have on QuantumScape? This was 2 months ago. How much borrow do you have on QuantumScape? And JP Morgan says, I can get you 1 million shares. That's the best, but it's going to cost you for 3 months, $2. And they say, this stock looks a little, it's probably $20 overvalued, they think. And they say, you know what? I'll take the 1 million shares and I'll pay you the $2 today. And that doesn't mean they're shorting the stock today. It just means that JP Morgan had 1 million shares, and they basically said, I'm going to pay you, JP Morgan, $2 for 1 million shares. That's $2 million. And you're going to hold those 1 million shares on the side for me when I need it. Those are my 1 million shares. We're going to get into a contract, and it's going to be 3 months. Okay. Fair enough?
Yep.
Okay. So JP Morgan has this allocation, or maybe they had 3 million. They gave one hedge fund 1 million because he bought it. They gave another guy 200,000, and then they have some more. And then as the stock goes to 40, 50, 60, 70, who's calling up JP Morgan? all the hedge funds. I want to borrow the stock. I want to borrow the stock. How much do you have? 10,000 shares, 20,000. And all those shares, the rest is taken out. My million that I paid, it's contractually obligated that they give that to me. They're not lending that shares to anybody. Those are mine. So whenever I want to short them, I could short them. And that's how that borrow market works. It's supply demand on the shares. So when you get to a situation like this, the options market is telling me, it's telling me that this situation is hot, meaning, man, there's no borrow. You can't short the stock. Go try an E-Trade or TD Ameritrade. Go try to short QuantumScape. Just say, I want to short, one share, and TD Ameritrade, they'll probably send you something and say, you can't borrow it. You can't short it. So you physically cannot short it unless you have the borrow. Okay. But people say, okay, well, then I'll just go to the market. I buy puts. If I want to short it, I just buy puts and then I could sell calls. And you can do that, but you're going to have to pay for it. You're going to have to pay, like we just said, almost $23, $22.50. So that's the scenario that I see. So when I'm looking at this structure and I'm saying, now we go back to add that element. The customer is buying the 185 put spread, for and selling the 115 call spread, and he's paying $4, okay, and he's doing that to make 11 on the downside, but he loses 15 on the upside. So it's 11 to make 11 to lose 19. It's not something that I would think it's enticing. It doesn't sound enticing. It's a coin flip. Then he's using the date January 29th. Why January 29th? Why not the 15th? Why not February 19th? Why January 29th? These are clues. Then the borrowability, I could see, okay, the borrow is ridiculous. The bid offer is wide. That's whenever the borrow is in trouble or there's a lot of demand and there is no borrow, the bid offer gets pretty wide. And so you have this situation where I see that the borrow is also very tight or non-existent. Now, what is that? What's the next level? So add to the process. Well, the shorts are a smart bunch of guys. The short groups, they are considered many times some of the smartest guys. Not saying that they make the most money, but they're in there in the weeds. They're looking at the accounting. They're looking for fraud. They're looking around, snooping around for fraud. Okay, a guy like Jim Chanos. He's a smart guy, founded the Enron back in the 2000s, the Enron fraud, all over that, and the accounting. When everybody, you're talking about the whole world is looking at the accounting, and he's looking at it, and he spots something that the whole world didn't. That's a smart guy. That's someone that is looking at the world differently than everybody else and figured out, no, there's something wrong with the way they're parking money here, and then it's going offshore, and we don't really know where it's going, and why would they do that? And eventually, it was fraud, complete fraud, and people went to jail. It's a great story, probably a dozen books on it, and it's a great read, okay? But Jim Chanos is a very smart guy. Now, because I see the borrow is tight, that tells me that the shorts are in the name, which then tells me that, they are betting for this thing to go way down, okay? Are they always right? No, there's a potential for a short squeeze, okay? But putting the pieces together where the borrowability is tough, where this person is doing this trade on January 29th, and he's doing this put spread versus call spread where the risk reward doesn't seem like it's in his favor. And then the question is, why would he do that? Well, the stock has also gone from 10 to 125. Maybe he's long, and likely to me, what it then piecing it all together is that he's using January 29th because he got a ticket on his desk that said, "Hey, Felix, nice. You just joined BlackRock. Congratulations. I appreciate you coming. You look like a smart guy. Here, I own 5 million shares of this QS. Get out of it by January 29th. You have 5 weeks." And that's how it works. BlackRock and Vanguard and all these guys who are long stock, they don't just say, okay, we want to get out, and they panic sell 5 million shares on one day. What they do is there's tickets and there's traders and there's teams that are looking at these things, computers where they're putting these things. And maybe they say, okay, well, we're not going to sell 5 million shares today, but by January 29th, I want to be out of 5 million shares, which means try to sell 250,000 shares a day for the next 20 days. That would be 5 million shares. That is how these big guys start moving their stock. So if I'm the guy sitting there and my job is to not only execute well, but also to find spots where I can perhaps get back some money for us if, us selling, if I'm sitting at BlackRock or Vanguard, I'm the trader. If me selling 5 million shares over the next 20 days is going to hurt the stock, well, maybe there's a way I can make a little bit of money back by doing that. And I can do this trade, which doesn't put any pressure on the stock necessarily. It did a little bit on that day, but it probably put a little bit of pressure because it was deltas against. But so it puts a little bit of pressure. But you know what? I will make 275% on this amount of money. We were going to sell it anyway. And so let me do this trade so I can get some of that money back. And then I can actively trade out of it once I'm done selling. So once I'm done selling, if the stock is 75.85, and this put spread is instead of $4, this structure put spread call spread, instead of $4, I make, instead of 11, I make 9, then I'll just get out of it and I'm done with my selling. And then I've made $9 for myself for this pad, against the money that we lost because my 5 million shares knocked the stock down 30 points. And that obviously hurt, but the only way we're going to get in and out of these names is by selling stock the way we did. So these are the types of things that, I think about putting it all together when I look at something and I'm saying, that is the puzzle. That's the way my mind works. Why would somebody do that trade? Why January 29th? There's reasons for everything. Nobody just picks it out of a hat and says, you know what, I think January 29th is a good date. It's usually not that. It's usually a very, very specific reason why January 29th. Why not January 15th? Why February 19th? Probably because January 29th is the end of the month and they probably don't want to be in the stock by the end of the month. So they're just giving themselves some time to bail out of stock. Maybe. Or maybe the selling hasn't happened yet. Maybe they're not selling it so that the report on December 31st looks like they're long and it doesn't look like it's selling. I don't know that reason. We will eventually find out that answer, but something is going on here where it seems to me that someone is setting up for a potential move down and they're not so worried about this risk reward that seemingly is not great, right? Like make 11, lose 19 on a coin flip. It's 50-50, right? But if you know that you have a lot of stock for sale and there's going to be a lot of pressure on the stock, then it's not 50-50, right? Okay. I'll play a game of heads or tails for $1 versus $1.10, but I'm not going to play 2 to 1. If the coin is rigged. So if you're going to offer me 2 to 1 on heads or tails, I'm going to say, why would you do that? Why would you play that? That that's not good for you. Why would you do that? It's because the coin is rigged. And that I keep playing, I'm going to lose. So somebody knows in the same vein, somebody knows that they have a lot of stock for sale likely, and the stock's already 120, 115 when they were doing the structure. And this is not something that, that is probably going up because I know I have 5 million shares for sale.
So when we spot something like this, what does this, what information does it give us? Is there any way we can use this?
So that's the golden question.
Right.
Nice job, Felix. Who cares? What does it mean for me? How do I make money doing it? Okay. So one way is to understand, once you see that and you can understand the way the market is positioned. Okay. That's one thing. And it's important. This is very important. I always talk about the definition of opportunity. The definition of opportunity is simply that your expectations differ from what the market's expectations are. In the options chain, through the RR dollar, through the yellow columns, I'm trying to show you what the market's expectations are for every strike. Okay, so when you're looking at every strike, that's sort of what's embedded in the price. When you have a situation like this, and Black-Scholes formula is breaking down, what you have to understand is that there's potentially calls are cheap. So if you think differently, if you don't think there's a fraud, if you don't think QuantumScape should go down, if you think QuantumScape for sure has a battery that's going to work, that will be the definitive battery for the motor industry, and you're really sure about that, or you really believe that, and you say, you know what, then I should be buying calls that are really suppressed. And again, why are they suppressed? Because remember, going back to the Robinhood video that we just did, now Felix is a volatility trader. As a volatility trader, if you're gonna sell calls to me, you're gonna sell calls. That means I buy the calls. What do I have to do? If I buy calls, I have to sell stock. But I don't have stock, so I have to short stock. So I have to call JP Morgan and say, can I borrow the stock because I got to short it? And JP Morgan is gonna say what? There is none.
Right.
And I'm gonna say, oh, then I can't buy those calls at the regular price. So I have to bid way, way, way lower for those calls. Okay, I might even offer them at a lower price because, again, everybody's trying to buy puts, sell calls to get short. So
Do you have an example where this happened? Like,
yes. So before I say that, I want to say to you that just because the calls are cheap, or calls not cheap, but they're lower value because everybody's selling the calls to buy puts, that doesn't mean anything. What matters, where the edge comes, or where your expectation comes, is what do you think is going to happen to the stock? So I'll give you a perfect example that I saw this last year is a perfect example. You have a stock called GSX Technologies. Okay. This stock had made a big move. Let's just call it 1 year and 3 months. Had made a Chinese ADR, big move. Okay. This was a $15 stock, ran up to $40, $45. Okay. And you can see my board, Marco?
Yes.
Okay. So
yeah.
Okay, so ran up to $45. The shorts were here, and then they came out with the story. This is fraud. GSX is fraud. There was videos showing why it was fraud, explanations of fraud. Everybody was talking fraud. And then the stock came back up, and then again they came out with another report. Fraud. And the stock is hanging around here. Right around here.
So we see. We can't see it? Just inspect it.
Let me inspect it. So you can't see it. Okay, good.
Yep.
Okay. Here. Stock runs up, fraud, again, fraud here. Okay. And somewhere around here, there's a lot of put buying. The borrow is very, very, very hard. The borrow is hard here. It's almost impossible here, which means what? You can't short the stock. Okay. Everybody's saying there's fraud. You cannot short the stock. So what are people doing? They are basically buying puts, selling calls. And they're putting pressure. They're buying puts, selling calls. Now, the calls, the 40 calls, I believe this is the case. The 40 calls, I want to say it was August, but it might have been July, but I believe it was August. August 40 calls, I believe right around here when the stock was 30, they were like $1. It might have been the Julys. But I believe it was the August. It might have been Julys. Let's just call it Julys. It was definitely not June. It was Julys. So the July 40 calls were $1 with the stock trading around 28, and everybody's calling fraud. Now, what I'm saying, what I thought there, I didn't buy these. It's very difficult sometimes. I didn't know enough of the name. I just when someone showed it to me, I looked at it and I said, damn, we sure it's fraud because the 40 calls, if they're wrong, the 40 calls are like, oh my gosh, this thing's going to explode, right? Because when someone screams fraud, and this is another lesson, and again, what I'm thinking, when someone screams fraud, the stock, okay, it went from 45 to 30. That's what should happen when someone screams fraud, an analyst or someone. Okay, fraud is a big word in finance and stocks, and if you scream fraud, you think zero, so it scares people. Now it goes up back to 42, and I'm wondering what's going on there, and then again screaming fraud, and the management's awful, they're criminals. Okay, stock gets back down to 30, and I'm thinking something's going on here. You scream fraud once, it's good. I get it. It goes down. You scream fraud twice, and it's not going below where it was. And there's a lot of volume trading, and everybody's getting out of the name, of course. And what's really happening? Somebody's buying this stock here because it's not breaking 30. And then I look at these 40 calls, let's call it July, they're $1. They went up to 50, or actually by July, they went up to about 50. 92. And if they were August and they were $3, they went from 40 to 140 is 100. Wow. But say they went to 50. But that's, I had to believe that the shorts were wrong. And I didn't have enough information to believe that the shorts are completely wrong. But that's a scenario where there's a short squeeze where, the company announces, I believe they announced even a small buyback. They announced earnings. It wasn't as bad as the shorts were expecting, the police to arrest these people, and then it didn't happen, and then you see what happened to the stock. These are all these shorts here, and this whole story unwinding. Now, look where we're back. The mountain, down, last gasp towards that mountaintop, tired, down, and now it's trading down. And you see now there are put buyers again coming in here. There are people. This stock is like a perfect Jim Chanos type of stock where it's fraud. He's going to keep at it. And, maybe he does buy calls to protect his short position. But when he sees this position, this is the mountaintop. This is that position that they're looking for. They are looking for this jump whether it was here, but it didn't drop, but there was still, there was still buyers because it went to the close at the high, but it opened a little bit lower. It eventually went all the way up another 11 points, 10 points, and then it broke this close, and then it broke that open, and then it broke this open, and then it broke this close. This was super negative this day right here. Okay, the shorts, look at that. That is, they're licking their chops here. They're licking their chops here, or even let me rephrase that. If they were short here, they're crying here. They're screaming, crying here. Here, they might be giving up. But the people who actually waited are licking their chops and they're saying, aha, this is what I've been waiting for. Now's the time. We're going to get huge here if we can. I'm sure the borrow was very difficult here. So it becomes very tough. So they're trying to use put structures or anything, the types of trades we were seeing, but they're licking their chops here. They're starting to attack it here. And this is just where they start getting heavier, because you see the market is, you see the gaps going lower this time. The closes are generally not at the highs where they're closer to the highs here. Here, it's people are trying to get out. Here, there's a gap lower. That's bad. This hurts. So it's not going to, usually they don't make it so easy. Like, oh, just short it and it's going to go back to 20. They make it almost impossible, right? They take down, then they rip it back up, and then they take it down. This is how, the mountain, going down the mountain works. This is why catching the crash is very difficult. People think, oh, I just shorted the stocks in NASDAQ 2000, and when it crashed, I made a fortune. Well, you had to literally live through the stock going from 130 to 70, okay? Then going back to 120, you just shorted it there. So you literally shorted it here, shorting. You might even be down money again because your averaging shorts are down here. It literally goes through 120 again, and then it collapses again. So the shorts are playing this game where they have it here. This is the side of the mountain they want to be on, but it's this last gasp that, the shorts are always well aware of, and they're attacking it. They're, on any move up, they probably covered this. You can look at Fibonacci numbers, 50% retracements. You can look at where there were gaps here. You look at volume pockets. There's a million different ways you can look at this with a technical analysis, but this is what's happening. This is, the way, the demise of a momentum story name. They will all, I think 90% of all of them will look like this eventually. I don't know when, and I don't know if the mountain that we're looking at is this mountain or if it's this mountain, but I assure you that most of them will start looking like this. So, and some are already starting, right? Some are already starting there, sort of like, this looks like every other stock. It's this final gasp straight up. This still could go to a $50 price target, meaning it could go from here. All is good, 50, and then it wipes out again come March or April. I don't know, but I see this as a name where the shorts are now licking their chops, saying, "Okay, let's go. Give me that one more move to 50. I'm going to pile into it again."
Right.
Okay.
Right.
So how do you take advantage of what I'm saying? One, it's going to point out when you see the Black-Scholes formula, when you see this relationship not working, or there's something. Let's just take it another one. I mean, we could just QuantumScape is nuts, but there's another one that I just looked at because it's name where the stock is. Look at the stock. It went from 10 to 50 here. They do laser sensor. They do these sensors that Apple is going to be interested in if Apple's getting into a car, blah, 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 blah. It's a story. Okay. It's a story. It's a $10 billion story. Is it worth 10 billion? I have no idea. VLDR, I took note, is the other one. VLDR and laser, LAZR. They're both up huge. Market cap of VLDR is 4 billion, lasers 11 billion. $11 billion. You know how much in sales laser has? $15 million.
Wow.
I mean, it's a joke. VLDR has $101 million. It has almost seven times the amount of sales that VLDR almost 7 times the amount of sales that laser has. VLDR does, and VLDR is 2.5 times less than laser. I mean, it's just the numbers are all baffled. These are stories, and once they get going, get going. But I look at that. You look at this stock, and who's licking their chops? Yes, the people that bought it at 10, they've made a lot of money. But right around here, I can tell you the shorts are starting to lick their chops. Okay, how are we going to make money on this laser? There's no way this stock could be at this level, and we're going to try to attack this name, or we're going to try to get this name. So if you want to look at the borrow For January 15th, just like we did in quantum, you can see that, let's just look at it, 32. The stock is trading, let's call it 31.87, 32. So you pay $5, you sell it at 3.30. So that's, you pay 3.30. So you pay $1.70, right? You're getting short at 32, but really you're getting short at 32 minus $1.70. So that's 30, spot 30. So you got to pay $1.57, which is about 5%. Okay, 4.98%, whatever that is. So 5% you have to pay just in the access to short the stock using options. But in the borrow land, if you go call TD Ameritrade might charge you 10%, 8% over the next 20 days, call it.
I see.
Okay. So again, you're spotting this opportunity. You now know that the borrow is tight, that the shorts are in the name. By itself, that doesn't mean much. But if what that's telling you is that the calls are relatively cheap because of this situation. So if I'm looking at, the February, let's see, the February 40 calls, they're 350. And somebody might say, geez, 350, look at quantum, look at all these. This thing could trade 100. Whereas, if you look at the relationship on the 40 calls and the 40 puts, you see that they're probably $1, $2 cheaper. It's going to look, quote unquote, cheaper than what you would expect. And the reason is because people are selling the calls, buying the puts. The Black-Scholes relationship is actually breaking down because of the borrow. And so I don't want to say cheap calls. You're getting the price of the calls at a lower cost because the sentiment is that the stock is going to go, lower, if you will.
So would you say that this is a good risk reward when you spot things like these?
Great question. I would say that it all boils down to where you think and analyzing it. Something like laser, I'm not ready to, the good risk reward would be if I think it's going to the upside. Somebody's got to show me why it's going to go to the upside. Do I think there's a possibility? I look at the stock and then I'll just, this is how you're gonna have to understand what the company's doing. But I can tell you that, they're coming in for options, and we're gonna just look at the last 3 months. Okay, so I can tell you that this does look interesting to the upside. It does look interesting because it has this, remember, not from a fundamental basis. I don't want people to think that I like the stock. The stock is incredibly overvalued on any metric, but that doesn't mean, as you see, that doesn't mean much in the next month, right? Nobody knows. But what I'm looking at here is sort of this clear pattern of, this stock comes from 10 to 48. If it breaks here, it could trade here. You got to be worried about or concerned about if it does this just to fake you out. But it's in this pattern here. If it breaks through, say, the 38.40, then, this thing could catch legs. This thing could catch legs. A lot of what's happening in these names, when there's patterns like this, you have an army of Robinhood users. There's those sites called 4chan and I guess it's Fortune and Wall Street Bets. And there's armies of traders there that, the shorts on some of these names are probably getting destroyed on some of these things. But because what's happening is the little guy, if you will, think of it like Braveheart, the movie, the little guy is saying, hey, if there's 1 million of us and we all buy, 50 shares, that's 50 million shares. We could take this thing up to wherever we want. And the shorts, because they're already short, they have to cover. So it's like this game of, it's a big boy game, and sometimes it's going to work, sometimes it's not going to work, but it's a big boy game of, can we accumulate enough people in our army to push through a level where the shorts have to actually say, I give up. I can't be short this name because I'm about to get killed. And then they have to buy 50 million shares. And that becomes a lot of shares to buy from who eventually the army starts, the army of, 50 lots starts selling it to them as it goes higher. But that's this game of seesaw of, does the hedge fund have enough money? They have a lot of money, but maybe they don't want to commit $50 million to a short on laser. And if there's news that's coming out that Apple's going to, eventually use these things, of course, that story is going to gain some legs. And Apple, they're going to buy how many trillions of, dollars worth of Luminar technology, laser sonars. Of course, the stock, just on the story, the stock's going to go up. So again, we're in that moment in time where stories matter. The hedge funds are going crazy because they can't, it's hard for them to pull the trigger to buy laser. In fact, most of them want to short it, but they're scared to short it because what's preventing laser from going to 32 to 100? If, Robinhood traders, 1 million people say, let's buy 100 shares. Now you got to buy 100 million shares. It's a lot, and it can push this stock to, levels that aren't seen, just like it did in QuantumScape. Is that fair?
Yeah, that's very good.
Okay, so your homework is to continuously remember this one video, which ultimately explains all the different things. It is the Black-Scholes, but I've never seen it done this way. Me, I try to do things that make it even simpler than what I've seen. It's not the Black-Scholes formula like you've heard it before, like you've seen it before. It's different. It's trying to show it to you in an easy to understand way, in basic concepts, to try to get you to understand that relationship. That's all the Black-Scholes formula is. They won the Nobel Prize because they made that relationship match. There was an arbitrage. The interesting part was, prior to the Black-Scholes formula, there was no relationship. That relationship was non-existent, and calls would trade here, puts were here. There was no that string or rubber band between the two sides was not there, and so there was people making free money. This is in the 1970s, when the commodities, people trade commodity options. So there was a lot of money to be made in the 1970s doing that. Even O'Connor, Swiss Bank O'Connor, with the O'Connor partners where I worked, and the people who taught me, that's how they made a significant amount of their money, because those relationships were broken. And you were down there, and there were, a bunch of geeky guys from Michigan and from, the University of Michigan and the Midwest, geeky guys with sheets. They used to have these sheets, and they used to be like, this, and there was these big football players in the pits pushing each other around, trying to get the trades. And these guys with the sheets that had the answer, they just say, oh, you're going to pay 5? Okay, I can sell a couple of those, and I can do that. And then later on, they'd come back and say, hey, how are the puts? And the puts are this. And I'd buy a little bit of those puts. And nobody knew what they were doing. And these geeky guys like, what do these guys know? We've been doing this for 20 years, trading in the pits. And they were basically making free money. It was free money. Ultimately, more people, know the secret. They learn it. They understand it. There were people like Susquehanna. People were born down there. A lot of these people made. It was free. It is free money. That's why it doesn't exist now. But when it first came out, Black-Scholes put it together. So that's the power of the Black-Scholes formula. That's what when you see the boards and you see all those things moving away from each other, then all those things, that there's a link. And when you see something broken, then you could start asking questions why. And when you're asking those questions why, and you see a trade, so now we actually saw a trade in QuantumScape. Now we could actually ask ourselves, why would somebody do that? Why? We're picking apart. And I'm trying to give you the steps in my brain as they're coming to me, but there's a lot coming to me, but I'm trying to show you all the different steps. It all starts with having the strong foundation. It all starts by understanding just that one little video. I have 50 videos of little things in each video that I'm going to show. And as I told you, I'm going to try to add to that, to do some of this live talking with the video, to show real examples, to put it in practice, and that's coming. So, I encourage you to keep going through those videos, go over them again. You think you know it, and you think it's easy to understand, but I want to tell you again, do it again. It's one of my favorite movies is, do you ever see the movie Miracle?
Maybe.
Miracle is a Disney movie, but it's about the 1980 hockey team and how they beat the Russians. And there's one scene that's awesome. It's I forgot the actor's name, but he's the coach, and he's basically getting these college kids who are like nobodies. They didn't even make any. They weren't professionals. They were playing against the Russians, who were professionals. And he got these college kids going back, and the coach is like, again, and he's making them go back and forth, and he's like, again, and incredible scene where these kids are puking, but at the end of the day, they won. So what I tell people is, I listen. I give you a question. I know I can see in your eyes. You may not understand. Again, go do it again. go through that options puzzle again, because you're not going to know options unless you understand that video. That's how important it is. And I want to make sure that everybody understands that video. So, and again, like I told you, that video is not in the top ranked videos that are watched on the program. And I'm telling you, it's the most important. So that is important. It helps you build that foundation of what you're looking at, which then can show you where possible opportunities are. Because again, to put that last link together, if I think that QuantumScape has the battery, then those calls are great value. They're great value. But it starts with me thinking that QuantumScape has the technology to be good and to be the one. Or I see some pattern, some technical analysis pattern that wins 75% of the time. And I'm comfortable, like the laser, where if it breaks through, I'm going to reach for those calls, because those calls, I know that they're depressed because of the Black-Scholes breaking down, but because of the direction, I can jump on those calls right away, and I can, I can basically get in and have all the shorts scramble and move to the upside. That's where the opportunity lies. That's where, where there's edge. There's not edge in just buying the calls. There's edge in knowing that the calls are sitting there depressed. And then the edge comes in either the formation of the technical analysis or in the fact that you understand the company fundamentally and you're saying, I like this company. And I think the industry's got it wrong. Okay. Which is a big statement to do. It's hard. I say it comes out of my mouth very quickly, but it's hard to go against the industry, but that is the opportunity. That's how the hedge funds make fortunes. It's when the industry thinks something and then bam, I think differently. And I'm going to use that because everybody's leaning that way. Same thing we talked about skew, about implied volatility, about there's no edge in just saying I'm going to trade skew or I'm going to trade implied volatility. There's only edge there's only edge when you believe, or your forecasted vol or your forecasted skew, when you believe that the market has it wrong. And if that's the case, then you can start saying, again, it's higher levels. You got to go through this. We got to go through it one step at a time, and I'm going slow with you. But, ultimately, when you start understanding skew and implied volatility and the direction and the risk reward, and you start putting all that together, that's really the edge. That's really when you understand options and you say, you know what, this is good risk reward here, and this is why. And the calls are suppressed for whatever reason, or the puts are really high. And maybe, we don't do put spreads, but sometimes, when put spreads are, when the skew is really, really high, put spreads don't look that bad, frankly. They don't look that bad. So if people want to use put spreads, I don't say don't ever use put spreads, but sometimes skew is so high that, you know what, you're getting great value to not only play the direction, but also to play the put spread. Is that fair?
Yes.
A lot going on there, man. I'm sorry. There's a lot going on. You did. And we took a lot. But you know what? I think it's important. Today's, not necessarily a big day, because I did look at the UOA prior to this. But let's just go through it a little bit real quickly under UOA and to see what we're looking at today. Yeah?
Good. Yeah, definitely.
Okay. So do you want to try it? You want to take a quick stab?
For sure.
I saw a couple of things, but I'll let you talk. Go ahead.
Just set it up. And in the meantime, I just want to let everybody know that tomorrow and Thursday, we're going to be doing a special session where Felix and I will be talking about implied volatility and two other types of volatility, as well as what it takes to be a volatility trader. So this is kind of a continuation of our Robinhood series. It's going to be really, really interesting because Felix dives deep into the matter, and I definitely recommend everybody taking a look at it. So stay tuned for that.
Good. I mean, we want to make sure that people understand. We want to make sure that people understand when someone says volatility trader, I'm a volatility trader, that you understand what a volatility trader is. I'm a brain surgeon. So I went to school to study brain surgeon. I've done it for 20 years. I'm a brain surgeon. Someone says, just passes the bar, says I'm a doctor. It's a little bit different. Granted, you did pass the exams, you're there, but you got to now spend some time in the emergency room. You got to actually have experience and whatnot. There's a difference. And so, it's important when someone says I'm a volatility trader, it doesn't just mean that, I sell puts and I sell calls based on where the volatility is. And I think it's going to go down. And it's we're talking about brain surgery and someone who just came out of college. It's vastly different. And so I wanted to make sure that people understand the ins and outs of volatility trading. It's not, we're not going to make it so complicated. I'm just going to show you and walk through. We did some of it in the Robinhood, and we're going to dig a little bit deeper, but I just want people, I want people to understand volatility trader is not something that you can become overnight. And you just, you watch 50 YouTube videos because somebody's explaining what volatility is and it's a standard deviation and blah, 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 blah. And it's like, oh, okay, now I'm a volatility trader because I know it's much, much, much more involved than this simple relationship between historical and applied volatility. So I think it's worthwhile for people to watch, for people to know, and for people to share so that they can actually, we could start telling people, you're not a volatility trader. You use volatility to help in your process, but you're not a volatility trader. There's only a few people in the world who are volatility traders, relative to the number of people trading options. So, okay, so we got that going on. But go ahead, shoot on your UOA.
Okay, so all right, here we go. Interesting things happening here with Apple, Amazon, and Snap actually caught my eye.
Goldman upgrade, right? Goldman Sachs.
Goldman Sachs upgraded. They said it's a $70 stock, I think.
Yeah.
And reasoning was partnership with Unity, partnership with Twitter, stuff we talked about before. And I mean, it's in my eyes, they're a main competitor to TikTok. Because I see my younger sister, she's either on TikTok or on Snapchat. So that's right. It's pretty interesting, and their work.
Which one do you see? Which option do you see?
Okay, so here we go.
I just want to see if we're looking at the same one.
Okay, so these are pretty soon. Volatility was up.
Yeah, the volatility is up. It's coming off a little bit. It was up a little bit higher before. Just when I saw it, it was clear that they were buying. Which ones did you see?
I'm looking at these 55s.
In what month?
In January 15th.
January, okay. January 55. So again, these are, when we look at January, it's only a few weeks away. It's very trader oriented, very trader oriented. There's probably some movement, the 50s. Like I'm looking at the 50 calls, 41,000 open interest, 7,000 on the calls. These 55s are interesting, 16,000. But let's see what happened here. It looked like stock up, volatility hit 60. It was like 59. It was up higher than it is now. So it was traded 59, then came straight down. So it looked like there was some call buying. Looked like it might have been call buying there. Stock went up and then eventually came down, and the implied volatility is down. So you could see how they made people jump 4 or 5 vols. It's a 3-week option, so the vol is not going to be too much, but it looks like buying there. I did see the Aprils, so that's the one I was trying to look at, because April is a little bit more of a setup, right? So looking at the April
60s
and the 70s, I think even the 70s. Let's see here, no spreads, paid up. So I thought these were buys. I just remember I looked at them right when I saw them this morning. 5,000. It looked like, again, they traded 67 vol, a little bit higher than the day before. So they look like they reached, and you can see right here, 66, 64, 66 right there. Okay, so look like, and on the offer, stock going up on the offer, and the vol was a little bit higher than the previous day. And then after that, the stock traded off, implied volatility came down. Now it's starting to creep back up, sort of finding its level, I guess. But I'm not 100% sure, but I think those were a buy too, which is a little odd because Goldman Sachs' target is 70 and someone is buying the 70 calls. So you'd have to think that the stock is going to 90. A little bit odd. So I'm not entirely sure there, but it is something that I was looking at. They came in also to buy in the morning. It looked like right here on the Aprils. Aprils to me is more exciting because people are trying to set up, right? Mm-hmm. They're setting up what they're doing. This isn't like, I know what's happening in the next 2 weeks. That's always a much, much harder game to play. So I would say,
right. But
go ahead.
Target seems rather high.
What's that?
Target price.
So if we're looking at, right, that's what we're saying. We're looking, so let me just actually do it. So I'm looking at this and saying, if they're buying these at 225, they got to think somewhere like 86. I said 90, and, that still doesn't even get me there. So, we're talking about, for it to be, it's so far out of the money, this is out of the shaded. So that's why it's not necessarily one that people would buy. So I don't know if this is, it's a little odd. it might be a sale and maybe it look like it's appearing like a buy, but sort of that's not matching up to me. It's not in sort of this window. This one's a little bit better in that window, and I can sort of, get maybe on board with the 60s because the 60s, to get to the 60s, you're talking about, oh sorry, 55. So it's in the 90s, like we said. But that's what you pay. I mean, it's 4 months. You pay for Snap. Can Snap be, if it gets to 80, you make 3 times your money. They're saying that you got to make 4 or 5 times your money here. So I think that I would think that it's closer. You probably want to be somewhere around 55 and be closer to 80. With the longer time frame, they're forcing you to go out further than you might think is necessary here. So, but yeah, this is interesting up here where the stock is there's a lot of activity. Why don't we look at another one? What else you got?
Let's look at a few more. You want to take a look, or?
Yeah. Let's say. Okay. I was looking at the LiDAR trades, the laser and
NIO. NIO seems interesting because they're holding their event this January 9th, and there's been some action happening on January 15th, $50
right
calls.
So the 15 calls are trading, and it's good size. So the 45 calls are 28. But what I see here is that this right here is not green, and if they were buying 115,000 options, you would think that this is green to open. So if it was to open, it would seem like it would be a lot here, a lot, meaning this would be a lot higher. It's not. So it seems to me maybe people are getting out of their positions. They're getting out of these 45s. They're getting out of these 50s. You see the open interest there? Open interest. So people could just be maneuvering here or maybe rolling out to February because they want more time. There's an event on January 15th, but the other thing that I do notice is, NIO is one of those names. It's, potentially on the wrong side of the mountain here. Let's get a clear picture. It had this huge move. Is that the big move, or does it go to 45 to 100 here? This is a big move from 3 to 57. It's come down here. It did this dance. It's held twice, which, if you're short this name, you got to be a little bit worried. It did hold. So this is a little bit different than, see something? It's a little bit different than this chart. You see that chart? Go back to NIO. This is a little bit more, it's moving, $2 a day, $2 a day, $2 a day comes, you see that's the gap of $5 to $10. That one is there. Now, this is a little bit bigger market cap, I believe, than QS, probably a little bit bigger, but this might not be the end of the show here. And you might have a blast to 100. If there's no reason why you couldn't go to 100. I don't care what the market cap says. It is what it is. It's not saying fundamentally it should be there. It probably shouldn't be 45, and it probably shouldn't be 30, but it does, and it gets there somehow, some way, and people are short, and then you get crushed. And then if I would say I'm more comfortable saying this is the mountain. For 6 months, come back to 6 months, and then maybe it'll start rounding about and do some work, or maybe a year. But I'm more comfortable saying, never sure, but if you had to handicap it 3 to 1, right? That's the mountain. Here, it's not even money, but I'm only like 1.5 to 1, right? I'm not going to be, oh, it's 3 to 1. It just doesn't have that same look. Make sense?
Yes. Okay.
So here I don't, NIO could be right. I'm not sure that people are actually gung ho about those January calls because they're buying. The vol's not up enough. To say that they're all buyers and this is all buying here. It's just not enough. It's not enough to make someone comfortable saying, we know that this guy who's doing this is buying the 45 calls. So that's what I would say there.
Okay.
I would look at something like, that I've been seeing buyers. That's interesting to me. Up a little bit, stocks up today, but there's been call buyers in this name over the last, couple of weeks. they keep coming each day. It's not in droves, but it's not like 10, 20,000, but they're there. They're there. The 220 calls here. What is this? This is, let's see, January, February. Okay, so small today. This stuff in January, probably positioning because there's a lot of open interest in the January options. So people are just closing things out for the end of the year and whatnot. But this is one to watch. The Visa stock chart. Sorry, the Visa stock chart is. This is a pretty good chart. I mean, it's you're talking about had this down move and it's holding steady here and it's near a possible breakout. It's in payments. We know that Square, PayPal having a little bit of trouble here. You sent me an email with the Google, the Google Pay and how an analyst is talking negative. It's funny how the analyst is talking negative here, but really we saw the stock weakness over the last few days here. So, that's another interesting, we'll talk about how those inside games work another time, but stock was already weak for 4 days while the market was good. And now the analyst comes out saying, and it's down another 5%. So this is a little weak, and PayPal is a little weak. And I guess it's always surprising that Google hasn't crushed the competition. But if they've woken up and saying, in order for us to be $1 trillion, we got to make all these little things that we have work, right? And work in some sort of unison, which goes to the story that maybe, Google buys something that like a Slack, that's a workstation to allow sort of people to have one place where they use all their tools. And that might be something like, I've mentioned like a DBX does that. So why not Google buy something like DBX, which is like, part workstation that they're building and part sort of this area where storage business or, memory for the cloud. So yeah. That's my 2 cents, but I would say Visa's one to watch. They're buying puts, starting at least to buy puts in Peloton. Interesting, starting to buy puts in, or not starting. I mean, people are usually, you don't see it when stocks are in the go phase. And Peloton, Palantir, there is some put buying around here that you're starting to see, and usually that hasn't been the case. This looked like some sort of put spread. 24.17.5 put spread that is trading. And I think that's interesting. I think people are, there is some open interest here, 34,000, 27,000. If you look at the holders, Steve Cohen is a big holder of this. Potentially after the stock goes from 10 on the IPO to 30, you might want to consider taking some off. So so we have that. What else? The last one I would say is this LiDAR sensors. I didn't even know what LiDAR was until about a year ago when I got stopped by the for a speeding ticket. And I was like, how fast was I going? And the guy says, you were doing, I was like, I don't think I was doing that. And it's all right, whatever. Give me a ticket. I was going to fight the ticket. And then I started looking up, and then these LiDAR sensors are pretty damn good. They hit you with a light and then they know the range and they know how fast it's going. So I was like, all right, I pay the ticket or whatever. So then when it popped up, I said, I can't believe that's going to make these companies worth $10, $11 billion. But I mean, apparently it is. So what is it? VLDR and LAZR, two names that you're starting to see call buying in. People, that is the hot story going into the new year. So I would say focus on that, but I would also say be careful of these growth names, momentum names going into the first 3 weeks of January. I would be careful. When someone big is doing that quantum scale trade, it gives you some idea. If they're doing it on one trade, they're probably looking at their whole book and they're saying, let's raise some money. We just took the stock from 10 to 120. Let's raise some money, and then let's take that money and find the next story for the next year. What is going to be the next story for the next year? If it's the LiDAR and whatever, a VLDR, then so be it. But the ones that have made a lot of money, maybe we just reduce some of that, and then if you look, a great way to watch story stocks is just look at ARKK. That woman made a career a fortune and a career on story stocks. What's her name? Catherine Wood, or I think it's Catherine. She's been, her calls have been brilliant. She, you know, some people might say it's luck. She's literally hit it right when the market is screaming, and everything is a story stock. Every stock she owns is a story stock. That they're taking in $400 million or something like a week. It's ridiculous how much her funds are taking in per week. It's bigger than BlackRock. I was reading. There's just not enough. You know, if the money keeps pouring in, which is a lot of retail, if the money keeps pouring in, then, you know, they got to buy these stocks, and they're apparently reaching limits. You can only buy up to 10% of a stock before you have to declare, and you can't be active once you're 10%. You know, you have to actually, every time you sell, you got to actually do forms. So, so stocks like, you know, a story stock like these two, Laser, LAZR, and VLDR and Laser, they're story stocks that, you know, maybe ARK is buying them because they're a story and they're the future, and she's going to be nibbling at them and maybe wants to buy them lower. But at some point, you know, that ARKK is something that you watch, because that is the story stock. So that's what I would take a look at. We'll leave that there. You know, again, we have 2 tape sessions for the next 2 days. So, you know, want to wish everybody a happy new year.
Happy New Year. We want to thank everybody and encourage everybody to subscribe and share the message, because we're doing this for you, and we want to be able to continue doing this, and we can't do it without your support. So thanks everybody for watching. Thanks for subscribing, liking, and commenting, and we'll see you in the new year.
Marco, take care.
Take care. Thank you. Bye.